hear me. If you can hear me, you can just dial in yes, loud and clear, and if you can see our screen. Coming to you live from the office in Noosa. This is the second webinar we've done during this crisis. I can see people slowly coming in. Hi Barry, hey Bernie, hey Greg, Deborah, John, Ken, Margaret, Patrick, Ray. Great to see so many familiar names. And we've still got people signing in. And hopefully we've got everything going well. I'm just gonna, if I can get some people just to type in the question box. So if you can hover over the control panel and type in your, just type in hello. Let me know that you can hear me. And if I can just get a few people to type in so I know that I'm not talking to my screen. I hope you're all thriving and going well in this strange world that we're in. And it's kind of interesting watching Noosa minus tourists, where, yeah, in a very strange world. And we've got some chats going on and all good. Thank you, Colin. Appreciate that feedback. So I'm assuming our sound is loud and clear. So I will say welcome and thanks as always to AIR for giving me the opportunity to speak to you guys. It's interesting. Today is May the 14th. Today was the day at this exact time we were meant to be meeting to go through the federal budget. And obviously, as soon as this crisis started, the federal budget was cancelled. They're now talking about putting that out to October. Lots going on. We're going to unpack that as we go through the day. And yeah, it's been an interesting world. Just to give you an update on what we've been doing. We have 170 wonderful clients. In our practice, we've been in contact with our clients that are very happy with generally, no one's happy with lockdown, no one's happy with slightly negative returns. Generally, we've had no panickers, we've been communicating regularly. And today I'm going to take you through a bunch of things. So I'm going to start this in a minute. We've got 31 people live online. This will be recorded, so we can make it available as a YouTube to those that haven't been able to log on, whatever reason, or prefer to watch it in their own time. Yeah, that'll be available. And at the end, I'll tell you how to get hold of the recording and the slides to this as well. Now, I'm going to turn off my camera in a minute. You've seen my, well, most of you have seen it before. And I'll talk a bit about what we've been doing. I am going to turn off my camera again and just stop the video so we can focus on the screen. And let me start the presentation. So what we're going to look at today, I'm going to take you through a step-by-step replay of what got us here. So this was what we'd call a black swan event, things that are not anticipated by almost anyone, except those that predict doom and gloom all the time. I'm going to talk about the current state of play, where we think we're at. And every time I talk about something, there's multiple things we'll be talking about. There's the economy, there's public reaction, there's public policy, there's government policy, and there's the investment markets. And ultimately, that's your portfolios. We're going to have a look at the impact on different asset classes and how they've reacted during this. I'm going to lift the bonnet on our process. So I want to show you what we've been doing both with our investments and for our clients in terms of strategy. So I'm going to take you through a detailed look at that so you can see what we do. I'm going to take you through a bit of background on that, about how our process has been developed over the journey. I think most of you know that I've been in the investment markets for, it's a bit scary, I think it's coming up to 36, 37 years. But I'm going to take you through some of that experience and how it's led today. And this is not the first crisis that I've helped our clients get through. I'm going to talk about what the path out of lockdown looks like and what the economic impact is likely to be and how quickly we're likely to recover. Now, I should point out that my opinion is no better than anyone else's. I actually go to the experts a lot here. So we're going to look at what the IMF, what some of the top economic forecasters are predicting, but everyone's guessing because we've never had a crisis like this one before. We've had financial crisis, we've had financial meltdowns. This is the first one that's been caused not by financial excess, but by a pandemic. So we've never ever had a meltdown in financial markets caused by a pandemic. And I'll take you through this in detail. Towards the end of the presentation, I'm going to get you to ask yourself 3 questions to assess how your investments and how your portfolio is going right now. And we will have Q&A. Some of you will send in some questions, and I'll get to those as we go through. If you've got any questions that come up, feel free to type them in. I've got Jodie in the room with me. She'll let me know when some questions come up. We may answer them at the end, or we may answer them as we go through. I have no idea how long this presentation is going to take. My guess is 40 to 50 minutes, depending on questions and whether we meander off. It may take a little bit longer. And I'm happy to stay on the line for the Q&A as long as there are questions when we get to it. So let's take us back. And I'm going to break this down into 4 swim lanes. So I'm going to go back almost a year just to show what's happened in the last year. It's been quite amazing. June 30, the end of the financial year last year, we were all greatly relieved that the Morrison government got in. Thanks partly to a lot of great work by groups like AIR. The lobbying amongst investors and things was fantastic. So we dodged a bullet tax-wise and all those things. We were just in trade war truce. The US and China had been having an ongoing trade war. And the market rebound. We had a downturn towards the end of 2018, which was a good 15% downturn in Australia, nearly 20% in the US, and the market was rebounding strong. So when we reported to our clients at the end of June 30, and we report every month to our clients through a video that we do, we do a couple of things there. We explain what their portfolios are doing, what the markets are doing, and how we rate the market. So in this market section there, and it may be small depending on what device you're on, but I'll talk you through. So at that stage, the ASX, we had a 1-year return of 11.2%, 3-year return of about 12.69, 5-year return of about 8.73. We rated the market as a little bit expensive, not too over the top expensive, and I'm going to take you through our framework in detail on how we rate markets and where we rate them now and how that evolves over time. We rated the S&P in Aussie dollar terms because that's where we all invest, so that's US shares, that's the S&P 500. We rated it as sort of between fair and expensive. It had a sensational run, 1-year return 19%, partly due to a falling Aussie dollar. When the Aussie dollar falls, US shares go up in more value than they do on their own. 1-year return of 19%, 3 years 14%, 5 years at 16%. So very healthy. And keep in mind, we're still below the GFC highs. Gold, which forms part of every one of our portfolios, was starting to spike up, which is interesting. Now, it was spiking up around trade war concerns. We had no idea what was going to unfold 6 to 9 months from now, but it was interesting to see gold starting to spike up, having not done a lot in the previous 3 years. We include gold in all our portfolios. We made a decision 4 years ago that in the Trump era of fairly highly volatile times, it was a great hedge to have gold in all portfolios. Not excessively, just enough to provide edge. I'll show you what that looks like as part of this presentation. And a balanced retiree would have been seeing returns for the previous year of about 8 to 9%, and depending on what time frame they looked at. So returns were healthy. That range of returns, we benchmark ourselves to all the balance, well, for each category, we benchmark ourselves to those. And we were sitting in the top 10 to 15% of returns. To give you an indication, the bottom 25% of those returns were closer to 5 and 6. So the difference between the top quartile and the bottom quartile can be about 4% per annum, which is absolutely massive over a long period of time. So what was happening in global economies? Global growth was around 2.6%. US was higher, and the US was ticking along reasonably nicely. the Trump tax cuts. We had low unemployment in Australia and the US. Iron ore prices were rising strongly, which was good for our big miners. Inflation was below targets, and keep in mind that inflation band between 2 and 3%. So the RBA target is 2.5%. We were sitting below that. Things were good. And in terms of the curve, what curve? We didn't know what a curve was, and certainly we weren't. There was no idea of what was to come there. So I put these numbers up so that when you get these slides, if you're comparing returns, very important to compare apples to apples. You'll see a lot of investment figures, and as you're having barbecues, I'm not having barbecues, but as you're having Zoom coffees with friends or starting to talk to people often talk about returns they're getting. And I find a lot of people don't compare at exactly the same time. So we see people say that might be in industry super funds, and the last statement they looked at might be June 30, but we're in December, and they're comparing returns from June to December, and obviously you can't compare. So let's jump forward to the calm before the storm. So January 31st, we were starting the US presidential race. The Democrats had a cast of thousands. It would eventually be narrowed down to two white males born in the 40s, quite what's the right word? Some people might call it pathetic, others might call it disappointing, at least in Australia. I know we've got at the moment 2 white males that are born in the 60s, and hopefully we'll get to see some more diversity of that over time. But anyway, I don't want to get into politics today. There's enough to get through without that. We'd seen we'd had some more trade tensions, in the lead up to Christmas, and you saw, some dips in the market, and that was around some potential US trade. It's funny that whatever we focus on seems really important at the time. The news loves to talk about whatever's happening, and look, just a note. Your internet may vary. We've just got a note from one person to say their internet has gone unstable. So we're testing this live. Our internet's pretty good here. So hopefully your internet will stay well, and we'll sort of see. But we know ours is rock solid. So hopefully, Margaret, in your case, yours stays good. I know it varies a lot around this. So depending on how many homeschoolers you've got around you. So we saw the markets actually starting to reach new highs. Now, I sent out a video, so I'm just going to hover around a few different screens here. But let me go to our blog. So on our website, on our blog, and this is publicly available, I do a monthly update. We will be turning this off eventually, but for people outside of our clients, they can watch this. So you'll see I do a normal monthly update, and we started to do some regular updates in between those monthly updates around the COVID-19 downturn. But around about the end of January, so when we were doing the January one for markets to the end of January, everything was about new highs. Markets were running hot, and let me go back to the presentation. And I'll get that running properly, bear with me. All right, so market's running hot. Have a look at these returns. The 1-year return to the end of January. Aussie shares nearly 25%, US shares 31%, gold 30%. So the trade tensions, nothing to do with coronavirus, but the trade tensions were starting to show. We had, I'm just going to move some controls here. So we had record low unemployment in the US. How quickly things can change. This is end of January. It's less than 4 months ago. So this was the calm before the storm, and the storm we didn't know that was about to hit. Inflation was below targets. So the US Fed rate was around 1.75%. The RBA cash rate about 0.75%. Now, the curve had actually started. We hadn't seen a curve, and I'm going to talk through the curve. But China, during late January, had started to have some cases. Now, at this stage, it wasn't really public. We've seen lots of political debate about whether China kept it a secret. We're going to see all sorts of things happen. Doesn't really matter. I'm happy for people to work out what happened. my job for my clients and people that tune into that stuff is to help them work out what to do going forward, not to who to blame. I find that to be a very unprofitable venture. We love understanding history to work out what happened and to learn from it, but certainly not to dwell on it. So here we are, end of January, great returns, then bang into late February, and stage one was denial. I don't know if you've seen some of the videos China's doing to pay back for all the Captain America stuff and the American stuff, but it wasn't just Donald Trump, by the way. The whole Western world was in denial in this first stage. Pretty much every single person, except for those that might have had a deep understanding of pandemics. I know I was. So if you went back and listened to my end of February sort of surmise, and you'll see the market had gone down, but at that stage it had only gone down about 10%. So we had the market at expensive. At that point, we thought fair value was about 6.4 to 6.7 in terms of the ASX 200. We got that dropped down to that fair value. So we were thinking that was a healthy correction. And I'll talk about this framework in a lot of detail. Gold was still, gold was on the rise at this stage and starting to go up 5% in that month. We're starting to see negative returns in 1 month for everything except for gold. And a balanced investor was down 4% in that month. Now keep in mind, that wasn't too bad, because if you jumped out to 1 year, balanced investors about 8% still, because of the good year we'd had before, and even over 3 and 5 years, returns were in the reasonable space. Now, at this stage, there was no big change expected by most. Now, I know you'll find someone out there, or you'll know someone who says they predicted all this, showing their balance sheet, unless they're a billionaire or trillionaire. They're not actually telling the truth. To be able to act, if you knew what was happening, you could have made trillions of dollars by shorting the market. And I don't think we've got, no offense to anyone, but I don't think we've got any trillionaires or billionaires on the line. So no one knew what was going to happen. We were just thinking a healthy market correction. But look what was starting to happen. This is the curve in Italy. So if you look at the curve, so at the end of February, Italy was just starting to spike up. And that was when we were about to hit the next stage. So I've called this sort of mid-March the Italian job. And this is where we had that initial downturn. And then we sort of wobbled sideways thinking, oh yeah, it's a Chinese problem, it's an Asian problem. It's just like SARS, bird flu, and those health issues, I'm not sure whether they were classified as pandemics, they were confined to China and Hong Kong. So anyone, we've got friends that live in Hong Kong, and the reason Hong Kong, Japan, South Korea were more ready for this was because of their experience with SARS and some of these other flus that didn't make it out into the rest of the world in any particular numbers. So all of a sudden, the market started to go over the cliff. And I'll talk about why in a minute, but we had record drops every day. It was painful, waking up every morning, seeing what the market had done overnight. I was waking up in the middle of the night, checking out what Wall Street was doing. And most of the time, we get a little bounce back and then we drop another 5, another 7, another 10%. And all of a sudden, we started to get response, RBA very quickly, and that was around the bottom of the market, by the way. So we had this double black swan. I'm going to talk about that more in a minute, but oil prices collapsed right about this time when the market started to go. And if you look at that date, and I'll talk about it in particular, it's right about when Italian cases started to come up as well. And we started to think, this may just impact the whole Western world as well. And what do markets do when they don't know what's happening? They go down, really simple. We had started to hear talk, Australia in a recession, and make no mistake, we are in a recession. The March quarter will be positive, the June quarter will be negative, and the September quarter will be negative, and that will mean effectively we're in a recession. It may be one of the shortest recessions in history. I'm going to talk about that in more detail. It may even be a depression. What's the definition of a depression? That's when economic growth drops by more than 10%. When you hear people talk about depression, do not confuse this with the Great Depression, which lasted 3 years. This may be one of the shortest depressions on history. because effectively that last bullet point there, we put the economy into hibernation. This was a man-induced recession, and the markets, as always, markets predict these things. Markets always go in a recession. I'll take you through some charts during this presentation. But look what happened. The Feds, why did the market stop falling? The market stopped falling not because the numbers were getting better. So around March the 23rd, if you look in Australia, we were hitting our peak of new cases. So at the exact bottom of the market, we were hitting a peak. March 23rd, Italy was hitting its peak as well. It took a lot longer to go down. All sorts of reasons for that. I'm not going to dwell on that now. But we were seeing the peak in some countries. We knew the US was going to be later, just judging by the data. So the market was worried. But why did it stop worrying and start to go up? It started to go up because governments started to tell us what they were going to do. So firstly, the Federal Reserves reacted with incredibly low interest rates, and they started to put the floor under the bond markets. So in a crisis like this, not only share markets fall, but bond markets fall. Now, when we say bond markets fall, interest rates start to go up, and particularly for lower quality bonds. We saw hybrids, I'll show you hybrids in Australia. So that lower quality, not government bonds, start to fall, corporate bonds falling. But as soon as the Fed, in the States in particular, but all around the world, started to enter those markets, we saw a rebound. And the initial rebound was pretty solid. Now, anyone that panicked near the bottom, as always, so far, is missing out on a recovery. I'm not going to tell you I know whether the market's bottomed. My opinion is that it is, but once again, that's just my opinion. You can find right now experts to support whatever opinion you have, by the way. If you think the world's going to hell and the market's with it, you can find all the doomsdayers out there to support it. If you think we're going back to normal in 6 months, you can find optimists to support it. Most people are somewhere in between that. I fit somewhere in between that. I'll unpack that as we go through. So that's what led us sort of up to that March bit. I'll just go one bit deeper on that. And I'll talk about this double black swan that we had. This is a headline from the New York Times on March the 6th. Oil prices nosedive as OPEC and Russia fail to reach a deal. Now, to the average punter, we think that falling oil prices is such a good thing because it costs us less to put petrol in the tank. And we saw crazy oil prices here, including oil prices drop for future delivery to below zero. The Australian government took advantage of that quite wisely and stocked up a little bit. Now, the reason the futures market dropped to less than zero is because no one wanted to take delivery of oil that they knew they wouldn't be able to sell. So they were happy to pay money to get out of the contracts that they had. They eventually reverted pretty quick as governments and others started to stockpile. But the reason stock markets don't like oil prices crashing a lot is because the oil economy is fairly big. So that's oil companies, in Australia, things like Woodside, but there's some big global companies. And the first reaction to oil price drops is always negative. Now, it often comes back, particularly as we realise that cost to lots of other businesses is a good thing. And I won't go into all of this, but needless to say, that double black swan was what pushed us over the edge in early March. And ultimately, it was the flattening of the curve that we started to see in the bottom markets combined with massive government stimulus. And I'll talk about that. So what causes markets to fall like this? It's effectively fear. So markets are driven by fear and greed, and it's like an engine swinging from one to the other. We didn't really get to see pure greed in this cycle. I'll talk more about that when I come to that framework, but we certainly went straight to fear. Uncertainty. If markets can't tell what the economy is going to do, if markets can't tell what company profits are going to do, then part of the market sells off. Now, not all of the market. I'm going to define in a minute who the players in the market are, but the key players are either investors or speculators. And it's predominantly the speculators and a small portion of investors that do the selling. Most of you, all of our clients are long-term investors. That doesn't mean we're trading all the time like a lot of traders, but there is a lot of hot money around that tends to drive markets at times like this. So when the market and the hot money has no idea what's going to happen, when they can't work out those profits in the economy, and when there's lots of bad news, the market goes down. Now, it goes down as the news gets worse. So I'm going to use some bad grammar here, so forgive me. But as we get more bad news, so as we get bad news that gets worse, the market drops some more. So as the cases mounted, but then the news starts to get less bad. And for the share markets, less bad is good. Now, a lot of people struggle to understand this because they look at what I call the lagging indicators. So during this time, the market was going up. A lot of people were looking at the death toll around coronavirus worldwide, and they were seeing that going up. They were going, why is the market going up and the death toll is going up? And it's because the market thinks ahead. The market was looking at the lead indicators, which is those daily cases. And as the curve started to flatten, so too did the inverted curve, which was the downward market, start to go up. Because the leading indicator there was new cases. Government stimulus as well. So in Australia, that was predominantly three-pronged. We had JobKeeper. JobSeeker actually came first. That was where we decided to pay an extra $550 a fortnight to those on New Start allowance. Some would argue that's closer to a living wage. I was having this discussion with a colleague on the way into work this morning. For anyone who's in isolation during this, who's lost their job, take away their debt obligations for a moment, take away if their kids are at private school, etc. But for most people, particularly the young ones, $550 a week at the moment, which is what they're getting, isn't too bad. They can't go out, they can't go to nightclubs, they can't travel. It's not too bad. So I thought it was a very good policy. JobKeeper, which is the government subsidising wages. Now, it's only subsidising wages for businesses 30% down. I note in the news in the last 48 hours, the media, and I'll talk more about the media in a moment, the media is provoking, all throughout this, the media is provoked. And I don't know how many of you watch the daytime media, the evening media, but they've all enjoyed this just a little too much, my opinion. The media's job these days has become not to report on news, but to make you watch. And they do that by sensationalising, and I'll talk more about this as we go through. And they're picking a fight now, and they want a bit of political stoush. So they're going to say, why are we still paying people? They're going to create a war between Labor and Liberal here. I'm not going to touch on that too much. I think JobKeeper has been good policy. For people to get that, they had to be 30% down. Because the government had to respond quickly here, there was always going to be flaws in the detail. When we look at, and when I've spoken to you guys on budget announcements, often a year later, I'll be talking about things that still haven't legislated. So in normal times, sometimes things like this take over a year to legislate because of the arguments around the detail. Obviously, both parties came together to get this thing done because it had to be done, and it had to be done quickly. But they will argue about the details. I'm not going to get into that debate. I'm interested, but it serves no value. And then we had cash flow boost. So cash flow boost was a boost to companies, and these are small companies like ours, where we effectively got a credit for the PAYG tax that we pay. So that's the tax that we deduct from our employees' wages. So that initial boost was maximum $50,000. So it was to boost small business, to help their cash flow during this crisis. That was doubled pretty quickly to be a maximum of $100,000, and that's been spread from about April through to the last bits of July, August, September, October. So that's been legislated. So people are expecting those checks. The combination of those things allowed businesses to keep people on. My good friends, the accountants out there, tell me that the government successfully outsourced a whole lot of Centrelink queues to the accountants, because what do business people do with these things? They ring their accountant and say, how do I apply this? Can you set me up for it? So accountants have been working like crazy to help their clients qualify. But all these things are good things. But we saw the market do that initial response, rebound as those things came out. And then we've sort of bounced around since. And I'll go through more about that because we're waiting to see some direction now. We also had the 750 boost, and some of you I know who've had a healthcare card at some stage may have even received that. And I believe there's another one coming. for anyone on any government benefit, but I think it also included those who had a health card at any stage. So all that money has found its way into gym equipment, home renovations. Bunnings is going gangbusters. Many people I know are busy, including me, doing minor renovations around the house, repainting. It's amazing how money wants to find a home. I'll talk more about that. Reserve Bank, as I said earlier, lower interest rates, printing money. Quickly, how do they print money? They print money by buying back government bonds. So the Reserve Bank just writes a check from itself to buy back government bonds. So it takes the bonds off the market. They actually have acted in both Australia and the US by buying corporate bonds as well. So they become the owners of those. So it puts money into circulation, and that provided bond market stability, which is so important in this crisis. Now, let me put into context. I'm going to take you through now the way we talk to our clients during all the time, but particularly during crisis. So we communicate monthly to our clients through a monthly video, not unlike this. Occasionally we'll do extra updates. We've done extra updates during this pandemic. And for years now, we've been classifying the market as being one of these three broad phases. We have a boom. They only happen about truly every 15 to 20 years. So we can see the boom that we had in 2005 through to 7, the boom we had in Australia in the 80s, booms we had in the 70s. So boom is where the market legitimately goes crazy. We call that FOMO, which is fear of missing out. Inevitably, and 100% certainty, following every boom comes a bust. Now, the bust is always in proportion to the boom. This is the first time we've had a bust which has led to fear that hasn't been caused by a boom. Now, some people may argue that, but I'll take you through some numbers shortly to quantify that. So we have the market in, and most of the time, however, the market's in either boom or bust. It's in what we call the wall of worry. So that's all this period in between where it wobbles up, it wobbles down. We don't really see any correction with more than 20%. So we don't see any bear markets. And 20% is the technical definition for a bear market. We see lots of corrections, 5 and 10%. We don't see any major drops. Now, I have zero concern for 5 to 10% corrections. Those people that spend their time trying to work out when they come go crazy. They would be called speculators or traders, not investors. So we are very cautious about when busts will come. And I'll take you through that framework. Now, I just want to quickly go through some of the challenges for investors in all times. But we have a prehistoric brain. When we hear a rustle in the grass, we think it's a dangerous creature. We want to run. In the market, when we hear bad news, we want to either, and we know the prehistoric response is fight, flight, or freeze. Freeze can be the best response in the markets if we have a portfolio that's designed to weather these things well. If we don't, it's not a good approach. Fight is not a great response because it means we tend to panic when markets go down, and the same with flight. I just want to get some purposes down. When people invest in the share market, they could be doing one of these things. We only put money into the share market for our clients, that is investing. We are not speculators. We find that that's incredibly difficult to do. I'll talk about my past history and my observing of players in the market is speculating. It's fun, but it's hard. It's more akin to gambling. There's some definitions there. I'm not going to go through them in the interest of time, but I'm talking about investing here. One of the biggest dangers I see in a downturn is when investors become speculators. And what that means is all of a sudden they're trying to predict what's going to happen next month or the next few months, and they start second guessing and they start adjusting their portfolio. So they've now gone from long-term investors to speculators. Extremely dangerous, very hard to do. There's very few people in the world that can speculate successfully. And the ones that do it well are called successful hedge fund managers and then multi-billionaires. I'm going to touch on our investment framework and explain how that's evolved. We've been looking after clients' money for over 20 years. We've been using this framework for the most of it. We now implement it better than ever. But it's based on these 4 pillars. I'm going to visit these at different parts of the presentation. But modern portfolio theory is just investing well according to the Nobel Prize winning theory that was developed in the 70s and 80s. So the right asset allocation, lots of diversification, regular rebalancing. The biggest impact on investors' long-term returns is their behaviour. That's whether they make good decisions, it's avoiding that panicking and all those things. I'll go into some of those examples. We are massive students of history. It's my biggest nerd thing as a human for me. I've studied market history probably more than anyone I know, and I'll show you some of those outcomes as part of this. But for us, every one of our clients has a personal plan. So we don't have investments without a plan, and those plans are based on people's goals, how much they want to spend, how much they want to leave to the kids, not only what they want to spend now, what they want to spend later, any potential aged care needs. And personalised planning is about managing their liquidity. And that's where this reserves comes in. I'm going to unpack this more as we go through. But once again, those three stages: fear, FOMO, and you'll see the examples of those. This chart goes back to 1950. So it's 70 years. So 4 cases of fear and FOMO up until this one. And my classification is we didn't get to FOMO this time. We got to wall of worry expensive, and that was our classification in January. But most of the time, the market's in the wall of worry. If you survive, if you hold your head, and if your portfolio survives these downturns, you win. There is only 3 ways that people lose money investing in the share market. Some of you may have heard me say this before. But the first is if you panic and sell during one of these downturns. First, for those that panic and sell, they lock in the losses, they lose money. Now, some people might say, well, they'll get back in, but all the research says they get back in at high levels for the vast majority of people. So there may be some freaks out there who get lucky, but it is luck. Once again, if you can do 2 perfect timing decisions, you should run a hedge fund and you become a multi-billionaire. So number 1 way people lose money, panic and sell. The other way is if they have to sell. So not one of our clients has had to sell any growth assets during this crisis, because the only reason people have to sell is if they need that money to spend. And part of our process, that reserves part of that process, provides between 2 to 4 years worth of reserves for them to spend confidently. By the time they earn income on that, that effectively provides anywhere from 4 to 7 years to get through this downturn. And the last way people lose, so that's 3 ways: panic and sell, have to sell. The third way is if they're not truly diversified, if they don't own the market. For someone that owns bank shares right now, they've performed worse than the market right now, and to the dividends cuts. I'll touch on that briefly. So a lack of diversification is hurting some people right now during this crisis. And it causes them anxiety, stress, and to worry about their portfolio. I'm going to unpack a little bit of my background just so you get a feel for, I guess, my suitability to talk to people about this. You've heard me talk, but let me go way back. Back in 1984, my second job, I went to work for a subsidiary of Hong Kong and Shanghai Bank, right as the foreign banking license was being created, and right as superannuation was made compulsory. I was an accountant, I was actually a trainee accountant at that stage, with a fund manager. In the 12 fund managers that worked for that company, 10 of them would go on to create some of the biggest fund management companies in Australia, including County NatWest, SG Hiscock & Co, Portfolio Partners, K2. And at this stage, I was all of 20 years old, but I didn't know how lucky I was to be sitting in a room with such high caliber fund managers. I moved to another high quality company in JB Weir, where I was the unit trust accountant, and this was in 1986. And I used to do the unit trust accounting for what's their funds, including some of their listed investment companies like AFIC. So I've known some of those companies for literally, I don't know do the maths anymore, but it's 30 something years, 36, 37. I was on a fast stage of my career back then, so I tended to move. I ended up with National Mutual Royal Bank, and then they got taken over by ANZ Bank. At that stage, I was preparing board reports, including during the '89 bad debt crisis for the banks. That's the last time in Australia that we've had a bad debt crisis. So part of my job back then was preparing the bad debt board paper for the board, for the ANZ board. So I got to see a good insight into what sits under bank balance sheets. And right now is the first time we've gone back to bad debt levels from '89, because we didn't have the same sort of recession that the rest of the world had in 2007. I took a sabbatical. Well, it wasn't a sabbatical, but moved to London for a bit of travel and a bit of work. And I worked for a company called the Institute for International Research. It was a conference company. It was run by a very eccentric Scottish multi-billionaire who later became one of the richest men in Scotland, became a billionaire. and it was fascinating to watch him. I became an expert on tax planning. Our headquarters was in Bermuda and places like that. That company, and I'm not saying this is a good thing by the way, but it was a fascinating bit of experience. That company paid more to tax lawyers than they did in tax. That Scottish billionaire, during the time I was there, we moved him to Monaco, so that became his place of residence. He had the private jet, the private yacht and all that, and that was when he was only worth 50 million back then, and I looked up these days, he's worth 700 million, and that's pounds, by the way, which makes him a billionaire in US dollars. Came back to Australia, had a couple of things that led to me being CFO of Bell Potter. They were Australia's fastest growing, and they're now Australia's largest retail stockbroker and futures broker. So I got to see broking under the bonnet, and it's pretty brutal. There's some good stockbrokers out there, so I'm not discrediting the whole industry, but brokers get paid when your money moves, and a lot of their philosophy is to create action so that your money moves, so they get paid. So I got to see the side of that. That's when I realised I didn't want to be part of that industry. I wanted to be a financial planner. I spent a couple of years independently consulting to various financial companies before I went out on my own 22 years ago as a financial planner. I first spoke to AIR. This isn't a photo from there. I couldn't find the photo. But first spoke to AIR back in 2000, and have been speaking multiple times regularly. And this was the last time, I think, when we were on the panel with Noel, Matthew, and Kesh at that wonderful session that you guys organised. And that was all post the last federal election, and everything was hunky-dory. So I don't say that to impress you, but just to give you an idea of my background and how these things have evolved. I wear 3 hats today. One is to lead an advice team at Macquarie Wealth Management. I have a team of 6 that provides provides our valuable service to our clients. We've been a boutique firm in Noosa since 1998. Won lots of awards. I'll show you some of those in a minute. We look after about 170 families. Those families have roughly assets outside their home and holiday properties of around 300 million. And we manage portfolios directly of about $180 million. In 2012, along with Greg Coleman, my business partner, we co-founded a national license called GPS Wealth. That went on to be the most awarded Australian advice group over those next 5 years, accumulating about 300 advisors. So we gave advisors coaching, training and structure to lead what I call non-institutional fee-for-service advice. I've been a fee-for-service advisor for all of those 22 years. So we don't take commission from investments. So that means we're not trying to turn people's money over. We're not trying to put it in certain homes. And as part of that role, one of my hats at the moment is investment committee member of the care investment process. So that's a process I created firstly back in the early 2000s, and it's a process that's been implemented through managed portfolios, of which we now run 1.5 million. It's been a top 20% performer versus its peers, including industry super funds. It runs at industry super fund fee levels, unlike most of the retail super industry, and it's 100% transparent. I'm going to lift the bonnet and show you exactly what we do and what we've been doing during this crisis. I'm not going to go through these. These are some of the awards that the businesses that I've been part of or led over that time have won. Particularly proud to be independently owned sort of space. We've got to be one of the preferred groups there. Our industry, the reason we started that group, by the way, at that point, 80% of the advice industry was owned or influenced by the banks and insurance companies. They'd gone from about 40 to 50% influence to about 80 to 90% influence. And we saw how that ended with the Bank Royal Commission. And they really should never be allowed to advise people on their money. But another story for another day. That care investment committee that runs 1.5 billion, I'm just one member on that committee. Some other very experienced people, including one of Australia's most successful economists and fund managers, and Manuel Caragiris, who's one of our investors, who's the chairman of the committee, Australia's leading academic in financial planning and finance. So Mark sits on government committees, including the regulation of financial advisors. He's an expert in behavioural finance, which is incredibly important. Graham Evans has been CEO of many Australian financial groups, and he's seen every train wreck in the last, it's up to about 4 years now. So the only reason I say that is to show you the depth of what goes into what we do. I'm going to tell you, we look after people who are independently retired and those in their 40s, 50s who are going to get to that point. That's our market. We don't do transactions, we don't do super rollovers, we don't do budgeting advice for people. We help people who are independently retired prosper. We help them dodge all the issues out there, and we're going to talk through some of those. But quick, you guys can read this, sorry, better than I do it, but yeah, it's everyday Australians who've done well. The three categories of independent retirees to us are those who are on part Centrelink, those who are what I call everyday millionaires, they're above Centrelink, it's sort of in that $1 to $2 million space, and those that have done very well. They're our clients. The bulk of them sit in these first two, but we do have quite a number of clients in that part as well. And there are people who are going to get there. I'm just going to put this up. This comes from one of my seminars, but we help people achieve an awesome independent retirement, and that's where they've got enough money, enough time, and peace of mind and confidence. The biggest challenge for lots of retirees, not everyone, is they just start to lose confidence, particularly in crises like this around their investments, around their experts and looking after them, but also they start to get to an age where they start to worry what their spouse would do if and when something happens to them. These are the attributes of our independent retirees, and I'm not going to dwell on this, but just to give you a feel, once again, you can read that quicker than I can say it. But they're people that want to live a great retirement, but they want some help with making smart decisions around money, making sure that they've got access to information. And I'm going to show you the result of that. Some of their frustrations, ever-changing rules, volatile share markets, complex products, low interest rate, and all the paperwork, hassles, and headaches of managing this stuff themselves. Now, the reason I tell you all this now is because during this crisis, there will be some of you, not all of you, that will be experiencing some pain in some of these areas right now. And I'm going to show you what we do so that if it's appropriate, over the years, we've enjoyed watching numerous members of AIR come on board as clients. Certainly not all, and we certainly never aim to be pushy around that, but we do have quite a number of clients who are also AIR members and some who are on the webinar today. So I write, for the last few years I've written a report every year, and in it, if you don't have this, you can download it off our website, but in it I talk about the 10 biggest challenges for retirees in that year. I want to visit this before we look at where we are now, because I don't think they've changed. Low interest rates here for a while. Well, guess what? They're here for longer now. If we were starting to think about interest rates going over the next 1 to 3 years, we're now talking 3 to 5, if that. And with lower interest rates, we now see the chase to yield. And I'll talk about some potential train wrecks out of that, because that is still my biggest worry for retirees, is that they start to chase yield. In other words, they say, look, I need to get 5 or 6% to pay for my pension. And talk about how you don't need to do that and how there are other ways to do it. Well, we've certainly seen share market volatility. We've certainly seen more media negativity, extremism and short-term focus. And we've certainly seen those that rely on bank shares probably fairly hardly hit at the moment. And then that re-emphasises these things. And watch this space, but everything we were worried about before the last election is going to come back somewhere in the next 5 years. It's not going to come back in the next 2 years, because my belief is at the end of this hibernation period, governments will actually cut taxes and spend money to get us growing. Unless there's a miraculous rebound, unless there's a vaccine in the next 6 months, before we come out of hibernation, I think we're going to see massive stimulus, different type of stimulus than we've seen now, but we're going to also see infrastructure spending, etc. So in this report, we show the 10 big challenges. I've been talking about this to anyone that would listen. This is one of them for 2 years. There's a company called Mayfair Platinum, who I've been predicting would end up with this exact headline. I've been talking about this for the last 2 years. Their advertising was centered around term deposits. If you Google term deposits in Australia for the last 2 years, their ad stood out at #1. They're paying more than anyone else for those ads. The watchdog ASIC has preempted here and launched proceedings against them, including they've got some other companies that roll up in alleging misleading, deceptive advertising, because they were effectively preying on retirees chasing higher rates. They got some credibility by appearing on people like Switzer and Kohler's interviews. Now, those people didn't necessarily back them, but you can see these interviews come from their own marketing, so they use that credibility to, let me just say it, to suck retirees into thinking they're investing in bank-like products. So Cola's interview was subtitled here, and I don't know, I want to qualify this, I don't know whether Alan Cola ever backed this in any of his stuff, nor Peter Switzer, although I know Peter Switzer had these guys appear at one of his wealth conferences. And by the way, everyone that appears at those wealth conferences are people that have something to sell. And I know that's most of the industry anyway, but you want to be careful if you're going to something. I'm not going to dwell on that. We've seen lots of you have hybrids, and we have hybrids in our portfolios as well. But a lot of people treat them like term deposits. And we've sort of seen during this crisis, oops, capital value can drop as well. So hybrids dropped, about 20% as well. So during a crisis, all of a sudden hybrids behave like shares. Now they've bounced back strongly as well. We can see they're back to sort of returns. But once again, people that panic or that have to get out will lose money. And for lots of people, they don't just own one. This is an ETF called HBRD, which at least gives people diversifications. I should point out, I should have done at the start, everything I'm about to show you in terms of under the bonnet on our investments here is an example of what we do. Do not attempt to copy this. Do not do this without advice. You can feel free to do your own research and advice if you want a hand with that. You know how to reach out for us, and we'll talk about that at the end. But yeah, so all of a sudden fixed income, big troubles. The banks, this is a chart that shows VAS, so it's the Vanguard Australian Share Fund, which precisely tracks the ASX 300 versus banks over the last 3 years. And banks have been underperforming anyway, but then they've dropped by even more during this crisis, and we saw the cuts in the dividends and capital raisings. And all these capital raisings we've seen, retail investors pretty much get scalped because they never get the deal that the lazy fund managers get. So the lazy financial industry, the companies go to the big banks, the Macquaries and the others, and they say, we want to raise some capital, our share price is $10. We're happy to sell it to the institutions at $8, and then we'll do a retail offer at $8.50. So the insiders go, yes, please, and they take up all the $8. Some of the retail investors take that up, some don't. So that means the share price settles somewhere in the, say, $8.90. So the fund managers, the lazy fund managers make a good profit. Oftentimes they're dumping stock because they don't actually want to own that much. So they're dumping their existing stock. And this has been going on for eons. And that's why fund managers get a little bit of a free kick in these times, but it's not skill. It's just being the first seat at the table. And it's also a detriment to retail shareholders. I don't know, some of you in the audience have a keen interest in this. Some of you are part of the Australian Shareholders Association. Looking forward to talking to you about what you've seen on some of those companies. So this was the antidote to those 10 problems. Let me just click through quickly. I'm not going to dwell on all these, but yeah, making sure you have high quality information and advice, whether you're a do-it-yourselfer who's tapping into newsletters or other sources. Obviously, AIR is incredibly valuable to its members. But AIR can't provide detailed advice. We've just seen ETFs, particularly the types of ETFs that we use, perform true to label during this, and other things not. I'm going to touch on the liquidity bucket strategy. That's our reserve strategy, and a focus on total return. I'm not going to focus on these, but particularly all these things still stand, and I will touch on commercial property. Commercial property is highly. I know I've got a question from you there, Bernie. I know you love your commercial property. Your question wasn't on commercial property as such, it was on property trusts. Property trusts, and we had a good look before the webinar. I'll just jump to this. Bear with me, I'll get the right screen. And yeah, property trust. So this is VAP, that's the Vanguard Australian Property Trust, so that's the index. Property trusts have done better than Australian shares during this, and it's not surprising. They've done better in this crisis because we didn't have a financial crisis. Now, this doesn't mean you shouldn't overdose on listed property trust. In the last financial crisis, the GFC, property trust did terribly, and it was because during the boom, during the FOMO period, they geared up too high. So when markets fell, gearing amplifies all losses. So we saw property trust drop 60 to 80%, while the broader share market dropped 50%. This time around, they've done better because of their stable income and because their gearing levels are still reasonable. They're no substitute for diversification, but they've proven okay during this crisis. So hopefully, Bernie, that answered that question. If you're online, I'm not going to go through all of these, but they're all planning bits and pieces. So back to our process, and let me dive into some of that under the bonnet and show you what this looks like. But part of what we've been doing as an investment committee, all during, always. So our core portfolio, and I'll show you exactly what's in this portfolio in a minute, but we regularly rebalance that. So that means when things get above what they should be, so if Australian shares are all of a sudden overweight because they've had a run, we sell some of those and buy the things. Rebalancing is one of the free lunches in investing. Regular rebalancing, the academic studies show it adds between 0.5% and 1%. It effectively pays for financial advice fees when done well. So we've done regular rebalances. We rebalance if we hit the limits, the portfolios, and I'll show you those in a minute, or if we think there's a tactical advantage. So when the share market drops, that's the time to be buying, not selling. If the share market's at an expensive level, that's the time to be selling. So for a balanced portfolio, we're trimming there. Our active investment, we also rebalance that. We take profits occasionally in the active portfolio. So in that first leg of the downturn, we took some profits out of the US share market. I wish we left that, stayed out of the market. We did get back in at the bottom of that first bounce because we did think, like the rest of the world, this wasn't going to spread. I'll show you the results of that, though. So we're still pretty happy with the results. We're constantly reviewing what makes up the portfolios. In our reserves portfolio, we have a highly active manager that's got one of the best track records of short-term fixed income investing, and that does include things like short-term government bonds, short-term hybrids, mortgage, the secondary mortgage market for the banks and other things. And in our enhanced return portfolios, we use some active managers there that are quite conservative, all done well. I'll show you what that looks like. So for our clients, I'm going to show you some real portfolios. So this is one of our clients' portfolios. It's around about a $1.5 million portfolio. So you can see the incredible diversification that these portfolios have. So this is through those portfolios. And I'll show you why we separate the portfolios, because separating the bits of the portfolio is super critical. If you remember the 3 reasons I said that people lose money, one of them is if you have to sell. So if you're in an industry super fund right now and you're in their balance fund, every month that you're pulling out, you're selling some shares because you have a portfolio that looks like this and you're selling some shares. The reason we have the reserves portfolio, that's where we draw pension payments out of, that's where we draw money out of in good time, money out of people to buy a car or to go on their holidays, and we've done that based on their plan. So you can see this portfolio, the rough split, we have around half in the core portfolio, in this case it's a growth portfolio. This has been their experience in the last 12 months. So the orange line here shows this exact portfolio, so this is a real client example, was up around 13% in that lead up towards the end of January. And while the share market dropped 36%, that portfolio only dropped about 17, 18%. And at the moment, that portfolio is sitting down just around 3% for the 12 months. We're pretty happy with that. Our clients are pretty happy with that because they'd seen good returns in the lead up. So this shows the returns of some of these portfolios. So our active portfolio, that's the one where we take occasional profits. That's the one where we have gold in it. And I'll show you under the bonnet on these in a minute. It's had a positive return for the last 12 months. So this is a growth portfolio that had averaged upwards of 15, 18%. In the last 12 months, it's averaged 5%. Our reserves have done their job beautifully. Boring is beautiful. About 2.7% for the last 12 months. Our growth portfolio has done exactly what a growth portfolio should, given what the markets have done. And once again, we do benchmark this, and it's currently sits in the top 15% of growth portfolios, even in a negative time. And our Aussie share portfolios and international portfolios are pretty much doing as we would expect. The international one has done better than the averages, partly due to exchange rates, partly due to the focus on some of those large, successful international companies. So overall, this portfolio is down around 3.3%. That's as at right now over the last 12 months. That's a good result. These clients are certainly not in the panic and sell, nor are they in the have to sell. I'll talk about some of the strategies we are implementing. Let me lift the bonnet. Now, please let me emphasize, do not go out and try and copy these portfolios. These portfolios are reviewed regularly. They're designed to fit someone's plan. I don't know most of your circumstances. I don't know how you're going to react to downturns like this, but I do want to show you what's under the bonnet. So you'll see a bunch of exchange traded funds here. They're 3 and 4 letter codes. I am emerging markets. So in this growth portfolio, we've got about 5% emerging markets, about nearly 4% Aussie small companies. We've got our fixed income is held between 2 managed funds. These funds both operate at the short end. In this current low interest rate cycle, we do not want to hold long-term government bonds. At the moment, you'll get 1 to 2% coupon for long-term government bonds, and if and when interest rates go up, you'll make a capital loss. We're not interested in risking that capital loss. We'd rather get 1 to 2% by investing in short-term to get the cash into that market. We own global small caps or US small caps, global real estate. Part of our international exposure is hedged through WXHG. We own the US market. We are reviewing our hedging. At the moment, the Aussie dollar did get down to about 59 cents. It's rebounded very quickly to 65, so we haven't changed our hedging policy, but it's something we've spent a lot of time on, and there will be a time at some point where we probably shift to some hedging, possibly around that 60 cent mark for the Aussie US. Vanguard Australian share funds are the top 300. So about 37% Aussie shares, about 20% bonds, and the rest in international shares and property. So our active portfolio, it contains emerging market, gold, US small caps, the 100 leaders globally. So this is one of the best exchange traded funds around. It contains companies like Amazon, Facebook, Google. It's had a spectacular run in the last 5 years. Be careful about when you add it. It's also about 60% US based, so be careful about currency. Once again, there's a lot of complexities to this stuff. This is why we have professionals and such an experienced expert investment committee to drive these sort of structures. Our reserves portfolio is nearly 50% cash. We use AAA, which is a cash-based exchange traded fund, which gets similar to term deposits, which we're going to see term deposits settle under 1% over the next few months. I know you'll still have some that are higher than that, but we're going to see them drop to about 1%. We use a fund called Realm High Income Fund. Once again, these aren't recommendations, general advice warning, once again, but it's a great fund. We discovered these guys 5 years ago as they were emerging. These guys do consulting work to the Reserve Bank and other things over the past. They're some of the smartest people I've met in fixed income. They make a great presenter at some stage for AIR, and we might have to, and we can certainly get them up. It's boring. If they deliver us 1.5 to 2.5% over the cycle, we're happy because that's the cash reserves portfolio. So once again, those reserves is where we pull pension payments out of. So just repeating once again, not one of our clients has had to sell any growth asset during this crisis. And I've got a question from Mike. Hello, Mike. How are you? And that question I'll address now. So it seems to me that we're looking at share investments over the next 3 years, so the performance of different sectors could differ markedly. Technology looks promising, yada yada, uncertain, travel, etc. Any thoughts? Yep. And Mike, you probably heard me answer these before. We prefer not to pick individual stocks and sectors. We believe the smartest money is in the price. So the best opinions, we saw travel companies get smashed very quickly. We saw technology companies hold up fairly firm. So every bit of smart research is built into the price. So I agree. In a modern world, I think tech will do better. That doesn't mean you should necessarily tilt your portfolio that because it's already in the price. There's always a risk some of these sectors that probably will do better get overpriced. So we've got all these different things going on. And the beauty of an index is it rebalances itself. We review the nature of our index from time to time, but it's very rare that we'll make a sector tilt. Our managers in the enhanced part absolutely are all over this. Our international portfolio is set up very well because it does contain those big companies like Facebook, Google, Amazon, and some of those leaders, which have pretty much been bulletproof during this. So hopefully, Mike, that answers that question. I want to talk about the psychology, because if I come back here, if I come back one, every bit of academic research over the last 30 years shows that the biggest determinant of your investment return is your behaviour. So that's your decisions about your asset allocation, but then whether you chop and change. Those decisions are driven by this pendulum that is the market. And the market swings between fear and FOMO. Most of the time, it's actually, as I said, the wall of worry. These 8 boxes on the right are the 8 biggest downturns up to now in the Australian share market. So we can see the number one was during the 70s. Ironically, when we had a spike in oil prices, we're seeing that undoing at the moment. So that caused the market to drop massively. Ironically, if you invested around anywhere in the ditch during that crisis, doesn't matter whether it's the bottom of the market or what I'm going to call the ditch, if you invested in the ditch, you did spectacularly well for the next 20 years actually. But all the way through to 83, but then all the way through to 1987 as well. They were the best times to be an Australian investor. Why? We had high inflation. So we get people starting to already talk about stagflation and other things again. Stagflation will not happen until we get a boom at the end of this, and it may not happen at all. If it does, as a diversified investor, it's not necessarily scary if you've got a good process that rides through. Because on the other end of stagflation is rising profits and rising rents, which lead to higher property prices and higher share prices. So stagflation was actually the best time in the last century for investors. So you've got to be careful about what you worry about. So this crisis, peak to trough, minus 36%. That places it at number 5 in terms of Australian share market downturns in the last 120 years, since 1890. So number 5, it's the quickest one. 1987 was pretty quick. This one was quicker, and it's been the quickest recovery. We've actually rebounded 20%, which now puts it back into a bull market. That's the theory. Whether it holds these levels at the moment, I don't know. I don't think we're going to test the old levels. I may get that totally wrong, but I'm happy to say that's my opinion at the moment. And I'll talk about why I think that. But once again, we've had the panic. For us to go lower than this, we're going to have to get news, which, once again, excuse my bad grammar, is more bad. So the news won't be, the news cycle in the next 6 months is going to be horrible. It's going to be talking about unemployment of 10 to 20%. It's going to be talking about economic contraction of 10%. But the news is going to be looking in the rear vision mirror. It's going to be those lagging indicators. It's already happened. That's why the market dropped so strongly, because the market knew that's what was happening. So it's only if the news is worse, way worse than expected, that we'll see it tested those lows. Could happen, not saying it can't happen. I don't think it's likely to happen. And I think we have way more chance that the news is less bad or even good, which will push us up back into reasonable levels. And I'll talk about why. So I want to also touch on those lessons of history. That's one of the pillars. Now I've got a question from Colin. Will infrastructure funds have land down valuations over the next 6 to 12 months? Will people fly, use toll roads, etc.? And they will. So there's multi bits to that question, Colin. It's a really good question, and it's one we spend a lot of time talking to our advisors and our clients about, because it depends which infrastructure funds you're talking about. So infrastructure funds that are listed have already reacted to the market. So the market cut their prices, but infrastructure funds that are unlisted, like the ones that the industry super fund owns, haven't been revalued fully to the same extent as the unlisted. Now, some harsh people might call that fraud, others might call it smoothing. Q Super, Sun Super, perfectly good funds, by the way, but they've chosen not to revalue to the full extent. That's caused people like Alan Kohler and myself to say, if anyone's ever been thinking about getting out of an industry super fund, the time is now. Because if you're getting out of the unlisted world into the listed world, you effectively get a free lunch or an arbitrage. Because these unlisted companies own some of the same assets as the listed companies. So you've got 2 layers here. Firstly, are you listed or are you unlisted? And then it's, once again, our belief is your infrastructure holdings should be broadly based. So people are going to drive again, they are going to use airports again. We're going to see such a boom in flying eventually. I know we're not going to see it in a hurry, but I guarantee you 30% of the population, and I count myself in this, as soon as there's interstate planes available, I'll be on a plane interstate. As soon as there's flights to New Zealand available, I'll be on a plane there. I know a lot of people won't be, but I'm tipping there's 30% of the population will madly scramble onto planes because we are cabin fever stir crazy. We want to get out and about as we get told. So hopefully, Colin, that answers that. It's a complex question, but learning from history last time, industry super funds, particularly their infrastructure side of things, they underperformed for the next little while because they outperformed during the downturn because they didn't mark to market, and then because obviously the listed side catches back up, they can't mark up during that time. So if you're in an industry super fund and you've been contemplating getting out, it's a great time to do that. Not saying they're bad, by the way, they just choose to smooth and not mark to market. Let me show you the profile of these 8 big downturns. So this is what was happening in the lead up to. So in every single one of the big downturns, and this is what we call it FOMO, the markets had run hot. In 2007, October 2007, the 5-year return was 22% plus dividends. So this 22% is without it. In 1987, the 5-year return was 38%. 38%. So in the lead up to this, in January, the Australian share market 5-year return was 9%. It's actually slightly under the long-term average. So even though people worried about the new highs, barring the pandemic, new highs are often the best place to invest. They weren't this time because of the pandemic, but they're often the best place. So my belief is we weren't in FOMO, and it's only in FOMO that or very expensive FOMOs, we start to put in place some protection in our active portfolios. And we had a little bit of that in place, not a lot, because we didn't view we were in FOMO. But we study history massively here. A blast from the past. This was an article I wrote to clients of Hong McGregor, the previous name of McGregor Wealth Management, and Holman's back in 2008. And this was just before the bottom of the market. I didn't know it was going to be the bottom. I didn't know what it was. But my basic assumption is always to calm people, to show them what happens in the past. And I'll break this out, but I wrote what was likely to happen, and then share market, at the very least, not to sell during a downturn, because you're already in the ditch. So when we look at all these ditches in the past, I'm interested in what happens next from the bottom of the ditch. So when we look at these big ones, and these come straight from that article updated for the latest one. So we've got these downturns of up to 50%. The increase in the following year, 25 to 50%. Now, obviously, 50% from the bottom doesn't get you back to where you were, because the math of investing doesn't work like that. If you drop from 100 to 50, you need 100% return, not a 50% return. But we nearly get symmetrical, and we saw this again. Markets bounce back pretty close to what they were down. So we've already seen this. Recession, in most of the cases, we didn't get a recession in Australia last time in the GFC, the rest of the world did. We will absolutely be in a recession this time. I'll show you some economic figures in a minute before I wrap up. But this is what I'm interested in. I'm actually not even interested in the time taken to recover, because a lot of people say shares take a long time to recover. That's irrelevant from where we are today. It's relevant if you had the time machine and you can go back to January. But for those of us that don't have a time machine, the only important thing is what happens from the ditch. And from the ditch, the returns for the next period are pretty good. So in the last one, we had about the next 5 years up, that was 8% plus dividends in Australia. All that 5% dividends, that 13%. So returns from the ditch for the next 5 to 10 years are particularly good. There is no reason to believe that won't be the case this time. Now, I'm not talking about the next year, I'm talking about the average over the next 3 to 5 years. And once again, if you try and time when that starts, you're starting to delve into speculation. I wish you well. It's an area that is almost impossible. Here's the US market and what's happened from the ditches in the past in the US. And you can see the green are the good times, the yellow are the bad times. we've got the tech wreck, we've got the GFC, but ultimately the markets come back quickly, and the good far outweighs the bad. And it's only those that the US, by the way, was 34% down during this downturn. Right now, we looked at the US at the moment. The US is back to where it was a year ago. So quite amazing. Keep in mind, they're up 20%. So it's actually back to where it was. Now, some people who are watching the lagging indicators, like death rates, like the economic data, looking backwards, they will not be able to fathom this. People that are pure economists make terrible investors because they don't understand that the market anticipates and thinks ahead. So once again, I'm concerned about what happens next. This is what has happened in the US. If we look at it after 3 years, small caps respond brilliantly and large caps respond pretty well too. So once again, from the ditch, stocks outperform over the next 3 years. Even after 1 year, who knows how quickly it will happen this time because it is so health specific. I'll speculate that in a minute. The path out of here, and I know I've gone over, I hope it's been interesting. I think we've maintained our audience, so I assume you're finding some interest in it, and it was a lot to try and cram into 40 or 50 minutes. I'm a massive believer in relying on experts, and some of the best experts in the world work for companies like the IMF and things like trading economics. Let me show you what they think is going to happen, because what they think is way more important than what I think, and I much prefer to go to. If we go to the IMF, and this is their website, you can find this. If you Google, this shows what they're predicting for calendar year 2021. So the dark green is countries that think are going to grow by 6% or more. That includes Australia, China, India, not the US. They're predicting 3 to 6% for the US. So this is for calendar 21. So you can see this bottom chart. It shows GDP annual growth. So this shows annual growth dropping to about 6%. Now we're going to see it drop between 5 and 10% for the quarter that we're in at the moment, and probably for next quarter, depending on how quickly lockdown comes out. You can see the red bars here, emerging markets. So they're predicting, and you can see the downturn expected in the economy. Now, one point to note here is economic downturn is nothing like market downturn. Markets are like this, well, Warren Buffett calls it the bipolar market. I forget what he calls that. It's Mr. Market is a bit bipolar. So while growth varies between 0 and 5% most of the time, share markets vary between -50 and +100. So share markets exaggerate, and it's because of that boom bust ball of worry mentality. And I've got someone with a question here. Let me just have a look. And as I said, happy to answer questions. Can't see the chart. Let me just check. It should catch up. Just going to check, Joe, you can see that chart. So it's not, it's not switching. Just
only the paths out.
What's that?
On the paths out.
Yeah. It looks like it's not letting me jump out of my presentation. Let me just test something. Let me come back to my presentation. I'm just gonna escape out of this. Bear with me. 1 minute. So, and I'll show you some of this. I'm just testing with Jody, my producer in the room. Does that show it now? Let me just user error. So click the wrong button at the start of this webinar. We now see the chart. So my apologies. Yeah, tech error. Thank you for those saying they could see the chart. So let me rewind. IMF data. Global people that study the global economies with more zealous than anyone else. Dark green, including Australia, 6% or more forecast for calendar 21. That means we're out of the ditch, by the way. Once again, that's just their opinion, but I do like opinion that's experienced and that has no vested interest. So if we go back, and this is what I was just talking about. Let me just hit a button here. See what this shows. This shows that different growth rates during that time. I don't know if I can pause it. I can. So in 2015, these were the growth rates around the year. So what they're predicting, so we came from 2019 to these type of growth rates, and right about here, 2019, we see most of the world is growing well. China solidly, the dark green there, the red bars, the basket case of Iran, but not much, not much in Venezuela. It's interesting, eternal basket cases and eternal basket cases. Most of the reds are all going well. So for 20, this is 2020. This is the hibernation-induced recession. They're saying -6%. There is some slight chance this will be -10%. In that case, the headlines will say depression. Once again, that doesn't mean the markets will go lower, because it's what we're anticipating next that matters. So this is what we're going. So when you see the news, when are we going to know we're in a recession? Let's think about what a recession is. A recession is 2 quarters of negative growth. So the June quarter will be negative. It's likely the September quarter will be negative. There's a slight possibility it wouldn't, but that will only occur if a vaccine materializes really quick. Don't think it's going to happen. But so let's say the September quarter, we will see headlines in October that say worst recession since the global depression. Well, guess what? The market's already put that into the price. That was why we bottomed on March the 23rd. So that will not be a surprise. That will not be new bad news. Amateur investors react to lagging indicators and old look in the rear vision mirror news. Professionals are looking ahead to see what's going to happen next on these data. So hopefully that helps. The other one I've got there is trading economics, and you can find this online as well. So just checking that that's now updating. So if I go to the G20, you can see the prediction. So Australia, they're predicting Q2 -9%, Q3 -6, -5, so that's June. So they're actually predicting that the December quarter will be negative as well. These are the annualized amounts, not the quarterly amount. So they're saying in Q1 21, we'll be back on track for 1% growth. Now 1% growth is disappointing, but it's growth. The market will rejoice if we're back there. And look what they've got, China growing back to, Indonesia, where's the US? US back to 2.3. They're obviously not a fan of the UK. UK still got Brexit issues to deal with. I'm not even going to go there. But once again, these figures aren't too bad. So that's sort of part of the path out. Let me go back to this slide. And let me get back into the slide view. I don't know about you. I think our governments have done a fair job. I'm getting very sick of being told what to do. I know we're doing it for the right reason, and I'll probably be a little bit controversial here, but I think our civil liberties have been massively eroded. The degree of which we in the West have said, yes, sir, we're going to do that. I think it's been a good thing, by the way, so don't get me wrong, but I believe our civil liberties have been eroded. Part of the path out, let me make this message loud and clear. We've had crises forever in the share market. On world scales, this crisis is kind of wimpy. Now, I'm not saying that any deaths are bad, but let me go to another site and just check where we're going in. And let me go to a Wikipedia list of wars that we've had. World War II, we lost 60 million people. I'm not going to go into some of these old ones, but China, Chinese wars, 36 million. World War I, 17.5 million. Let me go to some current statistics from our friends at Worldometer. This is one of my favourite sites. I like letting it sit there. I don't know if you can see it changing, but the current world population is 7 billion people. Every death is incredibly sad and incredibly tragic to their family, their friends, and to those, obviously, to that person. There has been 22 million deaths this year. 76,000 today, less deaths than births. Some of those way that people die, and I'm not diminishing this virus at all, but I am saying perspective, please. 5 million people will die this year from communicable diseases. 179 people this year will die of the flu. 15 million abortions this year. 41 million people will be AIDS infected. There'll be 619,000 deaths caused by HIV. There'll be 3 million deaths caused by cancer. There'll be 1 million deaths caused by alcohol, 1.8 million caused by smoking, 400,000 by suicide around the world. I get why we've had to do what we've got to do. This was always about pressure on the health system. At the start of this, we were worried about if the virus climbed, if the curve didn't flatten, we would get a crisis in the health system. I feel like we've gone beyond that. We're now trying to stop any death from just one cause, while we're oblivious to motor vehicle accidents, cancer, obesity, everything else. I'm going to be a little bit harsh here, but we're not banning sugar, we're not banning alcohol. In fact, Australia's limit is you can buy a carton of beer, 2 bottles of whiskey and about 6 bottles of wine. So we're encouraging alcoholism and mental health issues. We've had to do what we've got to do. Don't get me wrong, but I think we've overreacted. I don't know if any of you are following Sweden. Sweden attempted to truly flatten the curve, not to kill it. Our curve in the West, we now seem to be trying to kill it. In Australia, we've reduced it right down, which is good. Sweden didn't throw their economy under the bus. They remained partially open. And yeah, they are flattening the curve. They have no stress, no huge stress on their medical system. They responded by doing reasonable distancing, hygiene, by increasing the medical beds and all those things. So this is a clue for our way out. Now, I'm going to be a little bit controversial, but well, the media does not want us to get out of this. The media is predominantly controlled by politically correct people that lean on the left of politics these days, led by the ABC, but the commercial stations, particularly the mainstream news, are just as bad. Koshi, Carl, The Project, all these people want you to watch them. And you watch them more when there's a crisis. They don't really want this crisis to end. They pretend that they do, but right now their ratings are through the roof. The crisis will end, by the way. It always does. The big questions for us is, when does travel open up? When do big crowds happen again? That's what will determine, the speed of the economic recovery. And the question, how do we handle second and third waves? Are we happy to watch? Look at the waves that Sweden's had. But they've handled that by just partly letting it go. The way out health-wise is testing, and Australia has one of the highest testing regimes in the world. Let me go once again to our Worldometer site, and let me just get, so Australia right now, I'll just remind us of the statistics. We've had 7,000 cases. Now, while they're all unfortunate for those people, we've had 98 deaths. An incredible effort, by the way, to be that low. It's cost us a lot economically, and for the 30% of people that are suffering economically, and for whatever percentage is suffering through mental health, domestic violence, it's a big price to pay that no one's, not as many people focusing on. I know for you and for my clients who are over 70, you come in a higher risk group, so I know this is very important. I treat this seriously. My mother's 76. My favourite clients are all over 70s, not all, but most of them are over 70. So we treat this very seriously. We've taken the distancing and hygiene and everything very seriously as well. But perspective, in Australia, we've tested 1 million people. So we've tested 35,000 per million, one of the highest cases in the world, not the highest. We've had 4 deaths per 1 million people. So it's a fairly low outcome. There's, let me find, not there, some information out of New York, which has had it as bad. Some of you may have seen this, but this is a true analysis of the deaths. So this is by demographic, and yes, it has affected people of all ages, but by far the most is people over the age. So out of the 100% of deaths, literally 22, 24, 48, 96% is above 45. By the way, I'm in that category. But have a look at the underlying conditions. 75% of deaths had underlying conditions. When you look at that, particularly in the older age group, it's the vast majority. There's a lot that we don't know whether they had underlying conditions, and if you assume that some did and some didn't, the number's probably closer to 90%. With people that have died that had underlying conditions. Now, for those people, what Sweden has done, partly well, partly not well, and what we're all doing is saying that those people that have underlying conditions and that are in these higher risk groups should absolutely be self-isolating until we get treatments, until we get cures. And the ultimate solutions are treatments, they are testing, it is vaccine and herd immunity. I believe we're more likely to get treatments before we get vaccine. There are treatments, for instance, for things like HIV. There are treatments for the flu. There are treatments for the cold. Eventually, we will get treatments, which means most people don't die of this virus. At that point, we may open up to big crowds again and to travel for people that have that. We may not as well. Ultimately, a vaccine will cure it. We've never found a vaccine for the cold. We've never found a vaccine for HIV, and they're both viruses. It seems likely we will here. They didn't find one for SARS, but SARS just disappeared all on its own. It just stopped doing whatever it does. I believe the world will move more to a Swedish stance over the next few months as we realise the price we're paying economically, mental health, and other factors are equally as bad as this. Now, for those of you, and once again, I know this will be a little controversial, for those of you that do have conditions that make you susceptible, I know from talking to you are isolating, you are taking this very seriously, and we treat that very seriously for those as well. We're going to see a whole lot of debate. I feel like the debate is being led by that political correct brigade, led by their hero, Danny of the nanny state, Daniel Andrews of the nanny state, Victoria. Victoria's going to let everyone out slower, and apologies if I offend anyone's political beliefs there. I actually think he's done a fair job, but I think they are overprotecting, and I think all of our leaders are enjoying a bit too much time in the spotlight. But anyway, that's the end of my political stuff. So hopefully this has been helpful. I'm going to open the Q&A in a minute, but I want you to ask yourself 3 questions as we wrap up. Over the last 3 months, feel free to type in the answer. I'd love to do a poll, so feel free to type an answer over the answers to these questions. Over the last 3 months, has my confidence in my portfolio, or your advisor, or your experts, or your own investment skills, has it A, increased? Do you feel better than ever about your portfolio, your advisors, your skills? Has it decreased, or has it been smashed or plummeted? Second question, does the market, do your investments cause you stress, worry, or anxiety? And please answer these honestly. I know for some they won't. I know some of you are very experienced long-term investors. Some of you have been through a crisis before. They're all different. And thirdly, have you got key principles in place? Do you have a rock-solid methodology that gives you confidence in a crisis? We've showed you ours. I question whether most people actually have methodology. Some people, I'm not suggesting those in the room, so to speak, but lots of people invest like speculators, and that's why it was very important for me to define terms. And particularly in a crisis, they move from being investors to speculators. If you have a rock-solid framework, you'll be able to hold your frame as an investor and ride through. Our reserve strategy, once again, in a crisis, we've been running this strategy since prior to the tech wreck in the early 2000s, has held up incredibly well. And it allows people to hold good investments so that they can recover for the markets to resume their normal pattern, which is up. Quickly finish with our bear market survival tips, which we've been talking through with our clients all the way through. And I'm just going to check. I can see some questions going in. Stress, yeah. A good one for some, stress for some, marginally some concern. Thank you for being honest. I'm not going to name any names if you type in those things, by the way. You know who you are. So the bear market survival tips, 1, Don't panic, but let me highlight that's if you've got a good plan. You find out in a crisis whether you have a good plan and whether you have confidence in your plan. And if you've got a good plan, stick with the plan. If you're a long-term investor, stay as a long-term investor. If there are things you need to change, you need to change. For our retirees, we continue to draw down as planned. Some of our retirees have capacity because they're not spending as much or they had extra cash built up. So for them, we've considered buying opportunities. Some of our retirees have dropped their super pension payments. We know we can drop those pension payments. And that's meant cash freed up out of the reserves, and we put some of that into the market. We're not trying to find the bottom. We're just happy to be buying in the ditch because we know that works in the long run. You can consider, being slightly more aggressive. One of those tips I had was increasing your share market exposure. Moving up one risk profile is the equivalent of about 20% increase in shares. So if you've been waiting to get in, you're buying in the ditch. Don't wait for a perfect time. It never comes. If the market gets worse, I can guarantee you won't buy the bottom because the news will be horrible. Just like I guarantee there's very few people that bought at the bottom. We did have clients buy at the bottom, pure luck. It was because we're averaging in. We got in early because we thought the bottom would happen sooner. And we're still continuing to get in for those that have extra cash, etc. Ultimately, you can bring in reserves. We talk about 2 to 4 years with our client. Right now, the reason we have that is so they never have to sell at a bad time. So once markets drop, we know we can bring that down to a lower end potentially. We've done that with some of our clients. So let me finish with Q&A. And for those of you, we've offered this for years, but for our members, what I'm offering at this stage, Jodie's probably going to look at me horrified because I haven't actually had a chance to tell her. But for anyone that would like a free 20-minute call to give me a quick overview of their setup, to talk about anything that's worrying, to talk about potential strategies, we'll be able to help where we can, giving some general advice. This won't relate to stocks or sectors. I don't particularly do that. I'll probably tell you it's not my area of expertise. Good luck with finding opinions on that. My usual response is if you go and search out the analysts, you'll find for every stock, you'll find 3 buys, 3 sells, 3 holds, because everyone has different opinions on what's going forward. Our process has held up really well here. Happy to talk more about those of you that have lost confidence in your own process or your own bits and pieces. And for those that at the end of that 20-minute call that it would be appropriate, we'd be happy to schedule a planning session. We are busy at the moment, but part of we always enjoy taking on new clients from here. As I said, we have quite a number of new clients. So ring the office to book those calls. We'll make time available in the next few weeks. Just to give you an idea of my time in the last 6 weeks, been averaging 20 Zoom meetings a week. That's mostly with our clients. We've done over 50 reviews in that period, and we've been on the phone to many more. And we have seen, we've had an influx of referrals from our clients and the accounts we work with, looking to have either people help who aren't in a great situation or people who've been sitting on the sidelines waiting for a good opportunity to buy and who now want some help coming in. So I'm going to open the floor to questions. I don't see too many emerging. I'm getting some comments. Thanks, Jeff. Thanks, Colin. And Q&A, I'm opening up. Here we go. And I think we've actually answered most of them. I see your observation, Mike. Yes, Australia's growth rate projected to be the same as Zimbabwe. It's funny. I'm going to finish with a quote from Warren Buffett that one of the quotes, if we don't get any more questions, is it's only when the tide goes out do you see who's been swimming naked. And I'll finish with a few Buffett quotes, but when the market hits a crisis like this, you do see companies that were broke, read Virgin and others already. You do see portfolios that were broken, read, and I do fear for retirees who had an old school, predominantly bank portfolio. I do think that's a process that's dead going forward. I know it's worked looking back to the past, but I think there are multiple factors that will make that not a successful approach in the long run. The other quote from Warren Buffett is to be greedy when others are fearful and fearful when others are greedy. I'll go to some of the questions I had from beforehand. John, a question from John Payne. Thanks, John. Hope you're still on. Yeah, Warren Buffett's sitting on $1 billion plus in cash. I'm just trying to find the exact number. Why? It's fascinating, actually. My fly on the wall fantasy at the moment would be to be sitting at a Zoom meeting with Warren Buffett and Bill Gates. Bill Gates, they both donated billions, by the way, to helping the world's health problems, and the Gates Foundation has done that. And I'd love to hear what they're saying. Warren Buffett has so much money now. He actually got out of the airline industry. So a previous question, Mike, he dumped his airline stocks. And I can tell you Buffett's process is about seeing predictable profits. So even right now, Buffett would be saying, I can't tell what profits are going to do over the next year or two. I suspect he's also quietly buying, and he doesn't want to signal his intentions. If Buffett says he's about to buy, the whole market goes up and he misses out on his discount. He probably thinks there's going to be continued weakness. Our Australian share manager in our hands operates like that as well. They're continuing to buy steadily on dips and as they get a clearer picture on certain industries. But yeah, it's Buffett is Buffett. They keep cash as well for their insurance book because they are ultimately an insurance company. So hopefully John have answered that. I'm just looking at some of those other questions. I think I've answered most. Frank, I know you had a settling question there around grandfathering. If you want to take us up on one of the 20-minute calls, happy to talk about that over the phone. It'll be a quite specific one if you're listening. There was one of the questions on ETFs like GEAR, G-E-A-R. I've used that for my kids. It's highly speculative, so I've used that when I'm speculating, where they have a long time frame, and that's a geared fund. I wouldn't suggest it for any of my retired clients unless they would have a bit of a punt. It's extremely volatile and it's complex under the bonnet. So I hope that answered that question. And I'm just checking for more, and I'm just closing some of these. And I'm going to do a last call for questions. Thank you as always. Thank you to the committee too. I know this time you'd normally be presenting with a bottle of wine, and guess what? Yesterday or the day before, that bottle arrived before the presentation, so thank you. I have enjoyed it. Some wine from my wine cellar during this this downturn, and I'm just looking at questions. Oh, Jeff, there's a question on hybrids. I believe hybrids are quite a misleading class of investment. They actually carry an incredible amount of risk that people don't see. If you held, Virgin don't have hybrids, but if you held Virgin hybrids, you just lost all your money. Now, I don't think the Australian banks are going to be in that position probably ever, but I do believe an overexposure to hybrids is dangerous. We do hold some hybrids, but I certainly wouldn't be going ballistic on them. And the challenge to individual investors, if you're going to hold hybrids and you are a do-it-yourself investor, you're probably better off to look to some of the exchange-traded funds to get diversification. Colin, a question on the 6.2% unemployment number. Yeah, that's not even the real number. The real number is probably closer to 10. I'll just see if I can get back to the IMF by trading economics sites. You can see the number's going to go higher. It's going to peak somewhere between 10 and 20, but it's going to be short-lived because once we do get back out of hibernation, the 80 to 90% of companies that can open up and get back to reasonable business will hire. There will be 10% of companies that never come back. Their market share will be taken over by other companies that have prospered in this. There are companies that are absolutely booming right now. I'm trying to find, sorry, there were some other statistics. If you want to get some perspective, Spanish flu, 50 million people. Yeah, so a bit of perspective. I hope it comes into the debate in a minute, along with a whole lot of care. And I'm just looking for unemployment. Can I get that up? So let me look at employment. So this is a great website. And if I can find it under pressure, labour and unemployment rate. So this will show predictions for the G20. Look at Afghanistan, look at Albania, 16%, Armenia. Here we go to the G20, which is far more relevant. Argentina, 11. They're the Australian numbers. They're the forecasts from Trading Economics. They're very similar to the IMF. So we're going to see 9 or 10. Unemployment comes down slower. This is why the government's going to have to spend their way out of this. But we've had high unemployment before. Netherlands low. Sweden doesn't make the G20. Be curious to predict what it's doing. UK 6.5. That's interesting. Yeah, there's a whole lot there. It is what it is. It's a lagging indicator. And yeah, things like participation rates, as you say, Colin, exactly affect it. A lot of people right now are stopping for work because they're picking up an extra 550 a fortnight. They're quite comfortable on that right now. Not everyone, but some are. So there's going to be much debate, much political debate about when that sort of stuff stops. I'm fascinated as well. We're here to look at the predictions for Sweden. Yep, just as high as ours, 9 or 10%. Anyway, I won't go there. And I think we are done with the questions. Yes, the bag. Margaret, thank you so much again for the wine. I see if the bag is still there, the boomerang bag. Whether that message got through. I was recording another webinar at home yesterday when the wine arrived. Zoom is my new, I haven't been on a plane for 2 months. Zoom has become my new frequent flyer point. On that note, I will thank you all, wish you all the best. I'm not going to say stay safe, I'm going to say stay awesome. Stay sane and stay doing what you can do. I feel incredibly lucky to be isolated on the Sunshine Coast. It's been fascinating watching this without tourists. It's kind of nice in one way, but I know we can't afford it in the long run. And yeah, thanks for some of the feedback there on the sound. Yep, appreciate that. And yeah, I wish you all the best. Stay focused on the positive. I think we will come out of this better than expected, as always. I'm going to finish with the chart that I look at every single day, which shows that stock markets go up in the long run. If you're not an investor, you have no business in the stock market unless you like gambling and speculating. If you've got a good plan, you'll be absolutely fine. Thank you very much. I'm about to stop the share. We will make slides and recording available. We'll probably post them on our website actually and send out a link to everyone that registered today, and to Margaret and the community, thank you. And you can feel free to send out that link to the rest of your audience. Goodbye and have a great day.